This is a graph of the number of shareholders compared to its debit card holders. Do you see anything odd in this graph? Unlike other banks, Yes Bank has a greater number of shareholders compared to its debit card holders. But isn't that surprising? A company which has destroyed 95% of all investor wealth in the last 5 years is held by so many people.
Yes Bank.
Yes Bank.
Yes Bank.
Yes Bank.
Yes Bank.
Yes Bank crisis.
But what precisely could be the reasons?
उसकी वजह थी बैंक का डूबता कर्ज.
Every depositor that their money shall be safe.
Here's an article by Economic Times that shares with us a very interesting insight. Out of the 50 lakh plus shareholder base that Yes Bank currently has, 49.7 lakh people out of those have made an investment of merely 2 lakh or less than that. Though the total shareholding base has expanded, big and large investors have moved away from the stock, while small retail investors are still hoping Yes Bank to become a multi-bagger from here. Now let's look at this chart. Out of the 4 banks, only Yes Bank has performed negatively in the past 5 years. Yet the shareholders are constantly increasing on a monthly basis. The reason? Penny stock trap. But before we move forward and understand the penny stock trap, let us explore what penny stocks are. They are a class of low-price, high-risk public companies which tempt traders with the illusion of easy exponential growth, offering the chance to double, triple, or even quadruple their money, little knowing that they are incredibly risky. They may sometimes even be a part of a pump and dump strategy led by some fraudster. However, in most cases, they are not scams. They just do not offer any real opportunity for growth. There can be mainly 4 reasons that can be attributed to people's admiration for penny stock. First and foremost of them is lack of capital. Since retail investors don't have a lot of money to invest in the stock markets, they find penny stocks as the only option for them to acquire significant holdings in a company. Let's say you just have an investable amount of 20,000 rupees or so, which most Indians typically have. And you have 2 options, buying 2,000 shares of 10 rupees scrip or just 4 shares of a blue chip scrip worth rupees 5,000 a share. To most investors, the first option appeals more, since it provides them with greater control and sense of pride in terms of holding a larger quantity of shares. Second, this is a graph of Titan, and this is when Rakesh Jhunjhunwala invested in it. He bought it when the company was almost a penny stock and made a killer return out of it. Many people think that their penny stock would also turn out to be their Titan, but it hardly happens. Because of this, they miss out on picking time-tested, market-recognized companies. Third, another trap people fall into is that of rapid capital appreciation. Let's see this with an example. With a penny stock, people think that the stock will easily go from rupees 10 to rupees 15, making them a 50% return. But don't feel the same for a blue chip company that actually has the potential to go from 1,000 to 1,500. But what is often ignored is that it is as difficult for a 10 rupee stock to grow to 15 as it is for a 1,000 rupee stock to grow to 1,500. And it is as easy for a 10 rupee stock to grow to 15 as it is to fall to rupees 5. There's a high chance that one may lose their entire investment. Fourth, we have these headlines that do the job of enticing people to the dreams of making multi-bagger returns. While there's nothing wrong with these headlines, the naive retail investor perceives it very incorrectly. What he perceives here is a cause and effect relationship between penny stocks and spectacular returns. What he doesn't know is the hindsight bias attached to this thinking. It is only looking backwards that he can know of these stocks. And only a handful of these might have been successful. Given the huge risks associated with the penny stock investing, is it really worth it? There's high price volatility, unproven and opaque companies with little information to rightly access them, and also lack of volumes to easily liquidate holding as and when is desired by the investors. Now what can we do about this? First, completely writing down penny stocks on the face of it could be an option for investors who want healthy, sustainable, long-term returns. But for others scouting for potential multi-baggers who are willing to make an effort and take risk, a proper due diligence framework must be followed. The availability and accuracy of the company's fillings and financials must be inspected. Quality of management must be duly assessed. Enough trading volumes must be ensured such that it is readily liquidable. Second, retail investors could look out for fallen angel stocks. These are stocks of quality companies operating in highly cyclical industries and are experiencing a severe downturn. Consequently, they are trading at extreme lows from their peak prices. This can be the perfect opportunity of buying solid companies that have fallen because of bad times and are expected to bounce back. And third, for whom capital is a major constraint, investing in an index fund which provides you with an exposure of a whole bunch of stocks with a great historical return can be explored as an option too. While doing this, what is important is to set your priorities straight. What is the time horizon of your investment? Are you someone who is okay with losing the entire amount of investment? Is your end to investing, funding your education or retirement? Can you tolerate high volatility? Only if you're comfortable with this, should you consider penny stock. Otherwise, there are always other alternatives that would offer high-risk adjusted return opportunities. If you like this video, you will also like the video about ONDC where we discuss the case study of it.